All right, is it better to rent or buy in this current market when we see interest rates that have been hovering high and property prices that have moved up? We get a lot of questions from clients asking us whether or not it's a good time good time to jump in the market or should they just rent. So this week, what I want to do is break down the numbers and hopefully bring some clarity to help answer that question. And at the end, if you want to have a copy of the spreadsheet that I built, you're welcome to it, and just send a message and I'll be more than happy to send it to you. So let's go ahead and jump into it. Hey guys, it's Bill Stewart, and this week we're going to walk through what it looks like in terms of home ownership, both from a monthly as well as over the next 5 years. What does it look like, and what is a better situation if you're in the market to buy a home? Or should you wait and rent a while and wait for prices to come down and all of that? So, and a lot of times you're going to hear, well, it's always a good time in the market. It depends. This really boils down to whether or not you're prepared. Have you made the steps necessary in order to be able to actually accomplish the mission of home ownership? And that would be one of the things where you partner with the right team, real estate agent, mortgage lender. There's a lot of different pieces and parts that need to come into to really kind of help answer, make sure that you're prepared for it. But let's say you are and you're concerned about the interest rates, and that's really what this discussion today is going to be about. So I built a spreadsheet. We're looking at basically just a standard home somewhere around 300,000, 3-bedroom, 2-bath, and using that as a comparison in regards to how rent and all of that would go. So I'm going to share that real quick with you and make sure that we can see it. And so in this, what we're looking at, as you can see, we're looking at a $300,000 home. We're looking at a down payment of only 5%. And the reason why I'm doing this is because a lot of people don't have 20% to put down on a home. And so at this point, making sure that, at 5%, would that be something that more people are doing? And there are options out there in terms of loans and how that would work. FHA offers a huge amount of opportunity, and you can put as little as I've seen it as low as 3%. But I'm going to use 5% in this, so a $15,000 down payment on that $30,000 home. The interest rate, we're going to hover around 6.5. If you are using FHA, the interest rates are actually lower now, but we've been hovering in and around 6.5% for the last few weeks, so I'm using that as a scenario. Loan term would be a traditional 30-year loan. Property taxes, you got to estimate those in there. So I'm estimating on this property at $300,000, somewhere around $2,400 a year. And this is on a 4%, that you live in the house. We can get into details as to like the interest rate. South Carolina will charge you 6% unless you apply for the 4%. When it's your primary residence, you get a discount. And if you pay the 6% and don't put it in and apply for it, 6%, even though it only looks like 2% more, actually almost triples this number. So it's to your benefit to submit that application and get that down. Homeowners insurance, I'm using $2,000. It depends on who you use and what your coverages are. It depends on the age of the home. I've seen this lower. I've seen this higher. I'm just using this as a general understand, like just a point of reference. PMI, that's your property mortgage insurance. If you're putting less than 20% down, there's typically property mortgage insurance that comes along. It's similar to gap coverage in a car, where at that point, like the bank wants you to carry this insurance policy, say anything happened to you ended up defaulting on the loan, that at that point, that 20% gives them the opportunity that they can resell that house and still not lose any money. So they're basically hedging their bets, and you're paying them for it. So right now I've seen it as low, anywhere between 0.5% up to 2%. So I'm using 1% in this scenario just because I think that it's better to be conservative than not. HOA, depends on if you're in a neighborhood with HOA. I would say, average somewhere in the HOA fees up to $500 a year. I'm using $75 a month here just as a number. If you don't have an HOA, that's one cost you don't have to worry about. And some HOAs are going to be cheaper. Some are going to be more expensive. But in general, for a home this price, I would say this is a pretty comfortable number. This right here, this is a monthly reserve account. This is not something that you're paying the bank. This is something that you're paying yourself. So the reality of things like pest control or HVAC furnace maintenance, just general upkeep of the property, there are going to be some maintenance costs that come along with that in order to be able to keep the house up and running. And so I'm estimating about a 0.6% of the cost of the home for that, because I think that's a pretty fair number. We're looking both on a monthly as well as out 5 years. The appreciation value is about 2%. And we're looking at selling cost roughly around 7%. So when you buy a house, if you decide to sell it in that 5 years, there are going to be fees associated with selling the house. And so I want that to be accounted for as well. So that's realtor fees, closing costs, taxes, transfer fees, all of those things that come in. And so making sure that we've got that accounted for. And then on the rent side, 3-bedroom, 2-bath, if you're looking somewhere between 1,600 to 2,000 square feet, can range anywhere. I've seen it as low as 1,800. I've seen it as high as 3,000. It really depends on where you are. I'm using 2,200 here just as a general base. Renter's insurance, a lot of times home sellers are going to want you to carry a renter's insurance policy. I'm using $20 here. I've had rental insurance policies that have been $400 a year, $600 a year. It might be a little bit lower, it might be a little bit higher. Really depends on your coverage. I'm just kind of using that as a general number here. Pet, if you have a pet, a lot of times there might be some fees associated with that, whether it's through a security deposit, increased rent. There's a lot of different scenarios, or if you have other amenities that you need to pay for. So I'm just putting in about $50 there. So $70 over top of the $2,200 a month. And the expected increase, we're looking somewhere, I've seen rent jump from between 2 and 5%. It really depends on, where you're at and who the landlord is. I'm using 3.5% here just to be conservative and make sure that we've got it. So when we look at our monthly comparison, we're taking all of these numbers and we're basically estimating that your total cost from a home ownership perspective would be about $2,630 a month in payment. That's encompassing your interest and principal payment. That's your property taxes, your homeowner's insurance. This is your property mortgage insurance. If you have that will drop off. You have to make sure that you get alerted once you get to a point where you've put 20% equity in. So the faster you are paying down the principal, the faster that this number can go away. But in this scenario, we're just assuming that will not happen. Your HOA fee, $75, your monthly reserve fee, again, that's a number that you're putting into your own account, but just basically it's a cost of owning the home. And so I think it's good to have in there. So in this scenario, what you'll see is, between your total payment from home ownership here to rent monthly, this would be, you'd have about a $360 savings by renting, right? So it sounds good, right? Most people would be like, it's a car payment. I could do this, I could do that with the $360 a month. But the reality is that we're not going to be living most of the time in our spaces for 1 month, 2 months, 3 months. We're going to be living there for 3, 5, maybe 7 years, depending on what's going on. And if you start adding in things like moving costs, if you're moving from one rental to another rental, this is not something that I've captured in the spreadsheet. This is as if you were staying there for 5 years. So anyway, when we break down our total cost here, this number right here is the number over 5 years that would be pocketed if at the end of it you decided that you were going to buy. Now, what these numbers are in is you have a $300,000 house, $285,000 is what the loan amount was. Your principal over 5 years, you've paid $18,208 in principal down. So that $285,000 is reduced by the $18,208. You have paid almost $90,000 in interest. Now, interest is front loaded in all mortgages for the most part. You're going to pay very heavy on the interest side, very little on the principal side. So over time, your interest will become a bigger percentage over that 30-year loan. But in 5 years, most of that has gone towards interest. The future home value over that time, over 5 years, you've seen a 2% increase year over year in terms of property value. And so your property is appreciated at this time too. You've got about $31,224 worth of equity that has come in, that you have seen just by living in the house and just over time. Okay. So when we take a look at gross equity, what this number is basically taking the $31,224 and it's adding in the principal that you've also paid. So you have an equity total of about $49,000, right? Now this does not count the $15,000 that you put as a down payment, which if you were to sell, you would obviously realize that as well. I didn't want to use that to skew this number. I really wanted to take a look at just principal and appreciation, how that all plays out. the idea that your house is now you're kind of your own bank. Every month you make a payment, a certain amount of that goes in towards the principal. And so that starts to go against it increase the equity in the home. At this point, I would say you'd be pretty close to your PMI total, that you would probably drop your PMI. But at that point, it's, you're still looking at $49,000 that you've got there. And then if you were to sell that house, in that 5-year period, your total cost to sell the home would be somewhere around $23,000, leaving you about $26,247 worth of equity left over at the end. Okay. Now, on this, if you were to rent, your rent over time would have been, you would have paid $145,000 and $769. Like that's a lot of money based on the idea that rent was moving up about 3.5%. You also had your renter's insurance and pet fee and all of that other stuff. So it starts to go, it starts to move up. It's a pretty significant number over time, over that 5-year period that you've paid in. Okay. So your non-principal cost of ownership, like that, these are things like the total non-principal. These are going to be your cost of ownership, things like your taxes, your property insurance, all of the costs that we talked about in the home ownership side that we have to look at. So this is just the total of all of those things over the course of that 5 years as well. So when you're looking at the total cost here between all of these numbers and looking at this right here, which is the net cost of owning, like, is $121,000, okay, versus $145,000 in rent that you've gone out. And so at this point, the cost over that 5-year period, even after taking out all of the different things, your PMI and interest rate and everything else like that, in rent comparably, you're paying 100% interest rate to that property owner, to be able to rent that property. If you were to, where we saw in the monthly breakdown that you were saving $360 a month in the course of the 5 year, after everything flushes out, if you were to take that home and sell it, you would walk with approximately $24,000. So over the course of that 5-year period, you're looking at somewhere around $5,000 a year that you were making just by living in the house, doing what you were doing over time. Now, the problem with it is that, it still boils down to, is it financially comfortable for me to do what I'm looking to do? And that $360 could make a big difference if at the end of it, I just, I can't afford not to have that 360. So I don't want to oversimplify that scenario. I just wanted to kind of give a breakdown that, it's sometimes we're looking at what we see as a net savings. The misconception, and sometimes the mistake, is that, the longer, if we're prepared to buy a home, the longer we wait to buy a home, the longer we are waiting to be able to realize the true appreciation of what that property brings. And, especially if at the end of it, I want to move, now I could sell it and I could walk with $25,000 free and clear that I could use as a down payment on my next property. And again, we're in that $24,000. We weren't talking about the $15,000 that you put in, that 5% down payment. So you would recoup that as well as part of the cost of the property. So you got a $40,000 bank now, where you could go and put down on a house, which then at that point, you could either move up, move down, however you want to do it. But when I look at at $5,000 a year, basically I'm being paid the equivalent of close to $400-$500 a month to, well, really more like that $350 a month. I'm actually making that over time and pocketing that. So in general, the two numbers, once everything flushes out over 5 years, basically become most flat. So what you think you're saving, you're getting it back just in a longer term versus, on a monthly basis. So anyway, I hope that this brought clarity. If you're interested, I want to learn more about what that would look like in a scenario of what you're doing. If you want a copy of this spreadsheet, I'd be more than happy to send it to you. There are instructions in the spreadsheet that basically go into more detail as to how the numbers are working, how to work that spreadsheet. so that you can put in your own scenario. I put a couple mock scenarios in there just to kind of give people, an opportunity to take a look at like what a little bit different things, different scenarios. Maybe you're putting 20% down. Maybe you're PMI, you don't have PMI. Maybe you don't have HOA, those kinds of things. So feel free, drop a comment and we will reach out to you. We can send this to you. But I hope this is helpful because I think a lot of times it's not necessarily as clear to go through and have people understand how the numbers work in their favor. It's easy to anecdotally say homeownership is the best way to be and you're going to make money in the long run. But when I start to understand, I think bringing clarity and understanding as to why I'm doing something and making sure that matches what I can afford, what I'm comfortable with, and the lifestyle that I'm trying to maintain, that at that point, like it at least gives me better clarity as to what the roadmap looks like in 3 to 5 years versus, right now. And so anyway, hope it's helpful. If you find any value in this, please subscribe to, hit like, please subscribe. We do this on a weekly basis. We'll go into future in terms of how things like different costs that you need to pay attention to from a home ownership side in future videos. But I figured this is a great way just to kind of get the ball rolling and hopefully answer some questions, because this is it's always been and will continue to be a big question and big topic of whether or not it's the right time to buy and how it all goes. So as interest rates get better, that means that the overall affordability also gets a little bit better. But just be mindful, if interest rates go down, there have been a lot of buyers that have been sitting out there waiting on the same thing. So the concern that we see is that prices will inevitably go up as demand starts to shift back into the market. So hope you have a great week and talk with you soon.